From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Ferro. It is NVIDIA results day, the most important stock on earth, according to Goldman Sachs. Stocks are lower, they're nervous, and a little bit emotional. Countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up on the show, investors on edge ahead of two key market-moving events. Fed minutes, remember those? They're taking a backseat to the blockbuster earnings. And NVIDIA is in spotlight, as I say, after the closing bell, a tense countdown. We begin with a big issue. It's all about one thing.
NVIDIA's results. NVIDIA.
After the close,
it's going to be front and center.
What will be happening today with NVIDIA will likely trigger some, possibly some volatility.
The options are pricing in probability of a 10% move.
We, like everybody else, thinks earnings are going to be great.
The underpinning fundamentals are very, very strong.
They have incredible pricing power.
take a look at this year. NVIDIA is up nearly 50%.
It is a stock that's priced with a lot of optimism.
People are expecting a very, very good beat.
There's huge expectations built in.
The risk that I see in this is that in 2023, we had such concentrated performance.
You've got 40-50% earnings growth coming from Tech Plus.
On the off chance that they underperform, then there'll be some impact to it.
If something goes wrong there, I just feel this cascading sell-off.
NVIDIA's earnings are going to be the story that we all anticipate and wait with bated breath.
It's not just the numbers, it's the emotion that it will invoke. NVIDIA, in case you hadn't got the message, will deliver their results after the bell today. Mandeep Singh joins me from Bloomberg Intelligence. We're expecting revenue to grow by 240%. We have been misdanced before by NVIDIA. So set the table for me, data centers through to sports. Good morning, Mandeep.
Yeah, I mean, look, I think there's no doubt that they have the demand and the pricing right now that's driving a lot of the tailwind in the data center. The question for investors really is kind of assessing how frequently these chips will be refreshed in the data center, because as we know, traditionally, chips have a refresh cycle, whether it's on your smartphone, tablet, or at the data center server level. And right now, this thing is moving at such a fast pace that, by next quarter, they'll have their next line of their chips. And I think investors have to assess how frequently those will be upgraded. So training versus inference, as well as the frequency of refreshes, is what's going to determine, the pace of that data center revenue going forward.
Yeah, and they have that intellectual property edge, as everybody has been saying. Mandeep, thank you very much, setting the stage. My guest this morning on JPMorgan's Monica DiCenso, writing this. NVIDIA reports this week, and I'm not here to predict the earnings, but I have been advocating that people make sure that stocks like that, which have done so well, are right-sized in their portfolios. My guests are Monica DiCenso, as I say, joined alongside by Crossmark's Bob Dole. Okay, here we go. You talk about right-sizing, Monica. You talk about right-sizing in the portfolio. What goes through my mind then is, should I be paring back? I mean, this is a stock that's, just the velocity in it has been huge. To right-size, does that mean to downsize or just scale back?
Yeah, I think it depends on your goals. People tend to think in a very binary way. Do I own NVIDIA? Do I not? Do I own tech? Do I not? And I think you want to own tech, and you probably want to own NVIDIA as well. But do you need to own as much as you have now? If you've owned it the last 2 years, you are up a lot. And it makes sense to take a little bit off the table, take a pause. There's a lot of volatility going into earnings tonight, as you've talked about. Many clients I work with are taking some of their gains off, and they're selling puts to monetize that volatility. They'll happily buy it if it falls. And if it doesn't, they still have a core size position, so they benefit if it rallies. Kind of the best of both worlds.
Yeah, I mean, it's probably one of those stocks which it is worth paying up for the puts at the moment. They're probably quite cheap in a relative basis. Bob, let me bring this to you. This is what Goldman Sachs right this morning. Mr. Rubner over there. NVIDIA is the most important stock on the planet Earth. Everyone is in the pool, and they are positioning warning signs. The bar is high, and by high, I mean a big beat is expected. To that extent, this is the poster child of AI. It's added $500 billion in market value this year. Are you filled with fear, or how defining will today be for risk?
Well, the stock is probably the most important thing on stock on the earth today, given the earnings at the end. Look, I own some NVIDIA. I agree. This is not an on-off switch. You can own some NVIDIA. You don't have to be market weight. I'm not market weight. So if it goes up big after the close here, I'll underperform a bit, but I've got some insurance because I own the name. Look, a couple of 3 years ago, no one knew what NVIDIA was. Now it's on everybody's tongue. So it's the stock to watch today for sure.
I mean, there's a certain amount, people talk about emotional intelligence. There's the emotional quotient that we have got to try and disaggregate here. So there's the emotional quotient in looking at NVIDIA and Mag 7, and then there's value. And Bob, by any measure, still NVIDIA on a relative basis, perhaps to some of the other chip names out there, is still below on a forward earnings basis. So there is still justification to be long, isn't there?
No question. The stock is probably priced for an upside surprise. So if they report on target, the stock probably goes down. If they miss, that would not be good news at all. So they've got to beat those expectations, which are already very high, probably higher expectations in it than any of the other chip stocks, many of which I own because they're not as expensive.
And Monica, to you, in terms of how much oxygen this is sucking out of the narrative when you talk to clients, is it?
It is, and in a way, it's a little bit distracting because many clients I work with still don't have enough general risk on. And so they're getting a little caught up in, do I want to own more NVIDIA or not? I'd argue you probably want more risk across the board. You probably need to own more fixed income. You probably need to own more broad equities. I still see way too much cash on the sidelines. And to me, that's a bigger risk than for many people I work with, how much NVIDIA they own.
And this is what I want to get a sense from you, Monica, because I think most people tuning in this morning, they either have their professional day attention in whatever asset class that is, but they've also got their personal decisions to make. Cash, as you say, is the worst performing asset class in 6 out of the past 8 years. Is it getting easier to get them to prize the money out of the cash accounts? And if so, what level of risk are they prepared to take?
I still see a lot of comfort in the yield that money markets and treasuries provide. And I'm sure we'll move to the Fed at some point today after we finish with NVIDIA. But, we know the trajectory. Rates are going to go down. Whether it's in March or June, we know this is coming. And so that is the risk to me of cash. That reinvestment risk is very real. Clients I work with haven't faced that in a while. And so it's time to get them reacclimated to owning fixed income. And they don't need to go really aggressive. You can own short duration bond funds. They're going to earn you a bit more yield, take a little more risk in things like CLOs and ABS. And that's what you should be doing right now. Get out of that cash because in a few months, you're not going to be able to reinvest it in a treasury where you are today.
And Bob, if we can just bring it back to you, maybe let's just broaden the conversation. You're right, Monica, we'll get to the Fed in a moment. Don't worry, we've got Fed minutes and NVIDIA. We can evangelize both of them across the two conversations. But Bob, it's interesting, you talk about another rally which happened not unnoticed, but financials did quite well on a relative basis since the start of the year. Why the momentum there? Is it the anticipation? I presume a lot of it was on the anticipation in terms of the shift in the yield curve, but it hasn't gone according to plan exactly, has it? Has that run its course in financials?
I don't think so. Look, financials are very cheap on no matter how you measure them. And I would argue, at least for the banks, let's leave commercial real estate aside for a minute, a lot of the lending this past cycle took place out of the banking system. Therefore, their balance sheets are in very good shape. And then there are the financial service stocks, the credit card companies, for example. So a lot of good things happening in financials at a price to earnings, price to cash flow, pretty reasonable versus the rest of the market. That's why they're working, and I think they will continue to work.
Monica, you asked perhaps the single biggest question that most asset allocators will have to inwardly reflect on. China is grappling with putting a floor under the stock market, throwing monetary policy measures at the economy. I caught up with the Rio Tinto CEO a little bit earlier this morning, and he certainly seemed to indicate perhaps not calling the floor, but to a certain extent, a great deal has passed by in the housing market. You say China has never been as cheap in 15 years relative to the oil world index. Is this the floor? Is this the diving off point? Are you brave? Are your clients brave enough to pick up China?
It is so tempting, but people say cheap is cheap, and what stops it from being cheap? And that's the problem. We need that catalyst, whether it comes from more government intervention. You've got to get people comfortable that the real estate woes are permanently behind them in China. I'm not sure they fully are. And there's the question of the regulatory backdrop. And as an outside investor, can I feel comfortable investing in China? I don't think people are there yet either. That said, it screens as the one big dislocated market globally when equities in so many other places have rallied. And so I'm getting a lot of questions on it. People are wanting to add a little bit of risk, but in a smart way. They don't want all the downsides. So we've been looking at things like, can you buy some call spreads, ways that I can spend a little bit in case it works, but I want my downside to be limited because I'm a little worried about what the government could do at any day.
I've got the sense you've got some pretty sophisticated clients if they're into simple put strategies and actually into a little bit of covered calls as well. I'm going to throw, Bob, this question at you, just see what you make of it. Noel Quinn has got his stress this morning. He's writing down values in France, in China. He's taking hits across the board, but he's paying out more money. But what I do notice is he could go down as the smartest CEO of 2024. He's downsizing his exposure to US commercial property, down by 27% to just under $4 billion. Is it going to be another leg lower of deleveraging in commercial property? Bob, briefly.
My guess is yes, it will take a weaker economy most likely to expose some of those issues, but they're clearly out there. We all know that they're most acute, back to the conversation on China, with so many 100-story buildings with nobody living, totally on debt. So we've got problems here in the U.S. in commercial real estate, but probably nothing compared to China.
OK, well, certainly the images are potent. Bob, thank you very much. Monica, stay with me. We've got a little bit more work to do. Don't worry, we'll get to the Fed. Let's look under the hood at the stocks that are moving. It is about tech and Tesla. Abigail is with me. Abby, what have we got?
It's all about tech. And before we take a look at two big laggards on the day, let's take a look at one stock that's actually working to the upside. That is Amazon. Amid the news, the interesting news that the e-commerce company is replacing Walgreens on the Dow. This means that some investors, managers will have to index to Amazon. So we are seeing a bid there. Not so much for Palo Alto Networks, the cybersecurity company, plunging down 25%, heading to its worst day in at least 7 years. This as the company has cut their sales guide for the year to $8 billion from an estimate of closer to $8.2 billion. The stock up more than 120% over the last year. Price to perfection, certainly not delivering it. And that's one of the concerns, of course, that you all have been discussing, I should say, with NVIDIA down for a third day in a row, potentially down 1.7% in the pre-market. Concerns not just on the idea that it's price to perfection, that valuation that Bob Dole was talking about, but also the pressure to hit growth above 600% for a third quarter in a row. Can they deliver? And with the stock up over more than 230% over the last year, all eyes are watching, pressure's on. Let's see.
Yeah, the nerves are jangling on those NVIDIA numbers. Abby, thank you very much. Coming up in the show, the rate debate, it does rage on.
I think they are important because they give more detail, and probably it won't be only on the path of the rates cuts that, by the way, we expect to be displayed mid this year.
We're gearing up for those Fed minutes. That conversation next on Bloomberg.
I think they are important because they give more detail, and probably it won't be only on the path of the rates cuts that, by the way, we expect to be displayed mid this year, but having some fresh ideas on the quantitative tightening, because this is what can give some impulse to the curve to steepen.
That was a Monday's Monica Defend with Danny Berger and myself a little bit earlier today, unveiling her rate cut expectations. This as investors count down to the Fed minutes. That's at 2 p.m. Eastern. Hoping it further sheds light on the policymakers' thinking. Mike McKee is with us. He's in D.C. for the day. Mike, How important will these minutes be? We've heard some criticism about Powell and his flip-flopping, so the minutes are perhaps a little bit more exacting?
Well, they will be a little bit more exacting, except that they are 3 weeks old. They will tell us what Powell and company were thinking then. But the problem with these sets of minutes is we did not know at the time what would happen to the economy. We'll probably see in the minutes that they agreed March is too early. Powell said that in the news conference, and they'll restate the idea of 3 cuts in 2024, maybe conditions for beginning cuts. That could be the important thing today. We get their assessment of the economy and inflation, but remember, on January 31st, they did not know, we did not know, that CPI was going to turn around and go up during that month. That came a couple of weeks later, and so the Fed is maybe having to recalibrate. Certainly the markets have, which is the important thing. The minutes sometimes are edited to steer the markets. They don't need to really do that this time because the markets have taken March and pretty much May off the table at this point. Now, do we get something that will point to when they do it? We get a couple more inflation numbers before the March meeting, even PCE inflation, CPI, and then we have the Fed meeting. So we've still got a long way to go here, but probably people are going to look at these minutes and say, we knew what they're telling us.
Yeah, and as you say, a lot of water has passed under the bridge last week, specifically CPI, PPI, and UMich, although a lot of people have been disparaging about the politicization of University of Michigan data. Mike, thank you very much. Mike McKee. We'll bring those minutes to you a little bit later on and parse through the detail. Bob Dole, Monica DiCenso is with me as my guest. Monica, let me bring it to you. Job done for the Fed. They've brought the market to heel.
Perhaps. I mean, I think the market just wants to see this last bit of it come to fruition. A little more clarity on when the cuts are coming. The market's obviously pricing them in mid-year. I think that makes sense. But I do think that there's still that lingering question for some people out there. Will they actually start to cut by midpoint of this year? So I still think we need to see a little more directionality towards that.
Bob, it's a bifurcation, isn't it, between a Fed panel, presidents, who are scarred in many ways by a number of events in history. 1998, LTCM, long-term credit, go Google. It was a bit of a touchy moment in the hedge fund world, but it was 1998, followed cuts, followed by hikes in 1999, and there were other incendiary devices of policy mistake. Isn't that the issue here, that we have a market which has very little retrospective reference in a bond market and a Fed that is fundamentally frightened of their own shadow of mistakes?
So true. The dialogue is all about, today, tomorrow, the next day, maybe out to June and a possible cut, but the perspective is lost. Most Fed cycles, the Fed tightens until something breaks. Well, other than for a day and a half last April, we have that banking crisis. Nothing's really broken. Is that still a risk? The Fed is twiddling their thumbs, marking time, probably wishing they didn't have to say anything from now until, late second quarter when they come back up for air. So we'll all be watching the statistics. As Mike pointed out accurately, we didn't know anything about the uptick in inflation. We didn't know we'd get a bad retail sales number. Are these flashes in the pan? Are they beginning of new trends? We'll have to watch. And so will the Fed.
So then I presume you saw Larry Summers' discussion on Wall Street Week where he managed to ignite a 6% possibility of a rate hike. So, Bob, I mean, is that a healthy level of concern to have, an outlier risk like that? It's not consensus. It's a 6% probability. It's random walk theory stuff. But is there enough then to justify cutting?
Well, the Fed's certainly unlikely to cut when people are saying maybe rates are going to go higher. It just means there's a lot of uncertainty out there. We still have to see inflation behave itself. Look, the Fed has successfully brought inflation down. I'll use core numbers from round numbers, 6 to 4. That's the easy part. 4 to 2 is much, much harder. So there is more work to do. Have they done enough and just needs to work its way through the system? And I'm sure that's what Larry Summers is looking at and saying, we're not going to get to 2 with what we've done already. So there's a good argument, if you will, on both sides.
And Monica, you are very resolute about the wages component and the tightness in wages. And that is what you think will slow the disinflation progress and therefore mar the cutting cycle?
We believe so. But again, I think we need to see more data. The Fed is telling us they want to see more data before they're willing to say mission accomplished and move forward with cutting. And I think that's the challenge for market participants. Again, you talked about this. People are scarred. They felt like they waited too long to hike, and now they're worried they're going to wait too long to cut. And so there's just this, I don't know, frustration in the market is what I feel today, and just a lot of focus on when and timing. And again, I try to tell my clients, just step back. What do you think the trajectory is going to be? Are you positioned for that? And you do want to have some acknowledgement that maybe the market is wrong. And so it's about having some balance in your portfolio to be okay in either scenario.
Okay. Thank you very much. Let's see what those minutes deliver, if they deliver clarity at all. And by tomorrow morning, we will be absolutely, we'll have clarity. We'll have NVIDIA. We'll know the future. Bob, thank you very much. Bob Dole and Monica DiCenso. My guest this morning on the markets. Let me give you your morning calls. We've got Keith Lerner of Truist joining me around the opening bell. Let's see how scared, or not, as the case may be, he is of the NVIDIA results. Counting down to the market open, and there is a swing factor at play in NVIDIA. You've got Tesla, you've got NVIDIA, you've got Palantir, all on the downside. But we are nervous ahead of this set of numbers coming through from NVIDIA. And as I say, the market is gearing up for some pretty big violent swings, anything up to 10% either side. Nasdaq down 0.6%, and Breath is down 0.5%. With that in mind, let me get you up to speed with the morning calls on the Wall Street. First up, HSBC cuts Home Depot to reduce, saying the outlook for 2024 is challenging as operation costs grow faster than sales. Wendy's is downgraded at JPMorgan to neutral, seeing the stock remaining range-bound. This is you've got competition, capital intensity across the fast food category, and that increases. Finally, Piper Sandler cutting Palo Alto, the networks company, to neutral. The bank joins a chorus of Wall Street downgrades to the network security company. That's after it cut its full-year forecasts. Wow, down 25%. Coming up, Keith Lerner of Truist on the potential fallout from, you got it, NVIDIA's results. This is about a revenue growth of 240%. Never was expectation so high on one individual name to define risk and trajectory on Bloomberg. Counting down to a market open that looks a little bit lighter today. Obviously, the big focus is going to be on tech, and there is $200 million worth of options out there. You're going to have a swing on these NVIDIA numbers by 10% is what the options market is gearing up for. So pressure on the equities. It takes you back to 2007. Either you believe that that was a moment that Apple was going to soar and on its way to the next milestone, which is $4 trillion. Is that NVIDIA's story? Is that what you've got to work out? The valuation of NVIDIA relative to AMD, relative to the rest of the stocks in the market, euro-dollar is flat. Now, technically, the euro is up for the 6th day in a row. I know it's hanging on by its fingernails, but you've just sort of got to go with the technicals. 6th day in a row, the euro is up. Yields drop. We're waiting for an auction of slightly longer dated paper, and crude is flat at the moment. 76.99 is where we trade. Look, we've talked about one big tech company, which is NVIDIA, but Palo Alto Networks also cutting its annual revenue forecast, putting the stock on track for roughly the worst day in nearly 7 years. Abby, talk me through the downgrade from the company.
Well, and it's actually gotten worse. The trading action, we're now looking at the worst day ever since this company went public back in 2012. In addition, this is the 4th down day in a row. So that means that this stock traded very poorly into its quarter, similar to NVIDIA. Doesn't mean that NVIDIA is going to put up negative results, but when a stock trades not well into its quarter, it sometimes means that there are folks out there that know things that we don't. What they may have known in the case of Palo Alto Networks is that the guide for the year was not going to be so smart. They took down their revenue guide to a range of $7.95 billion to $8 billion, below the estimate of just about $8.2 billion. They also guided down on billings. They're talking about the idea that businesses are growing tired of purchasing security. That's always a concern around the IT spend. Will it slow? So they are talking about that a little bit with the cybersecurity spend. What makes that interesting, we of course have had these big hacks in recent years: Clorox, MGM, Industrial and Commercial Bank of China. You were talking about downgrades. Well, we do have at least two. Loop Capital cutting the shares to a hold from a buy, and also Piper Sandler neutral to overweight. The stock, as you know, into today over the last year up more than 100%. Price to perfection. They did not get it. The stock down about 25%.
Yeah, it's brutal whenever it's their own downgrade, which undermines all the bid. Abby, thank you very much. Abigail Doolittle on one of the stocks we're watching. Let's stick with the earnings. We've got shares from Toll Brothers hitting a record high, that after they posted better than expected results. Katie Greifeld is with me. So it's yin and yang, isn't it?
Yin and yang for sure. We're talking about a luxury home builder here. It's really jumping after reporting a strong start to the spring selling season that helped produce a beat and raise quarter for Toll Brothers. Looking back, Toll Brothers reported that orders jumped 40% from the prior period to more than 2,000. Analysts had been looking for around 1,900 or so. And looking forward, the company said that deliveries would range from 10,000 to 10,500 for the fiscal 2024 year. That's an increase from its previous forecast. Now, to get some commentary here, in addition to, of course, the strong spring expected, the company also said that it's benefited from the improving job market and consumer sentiment, and not to mention an extremely tight inventory of existing homes. That has really been the story of the entire home building sector, and it's why Toll Brothers has more than doubled since the end of 2022, and it's adding to those gains today, of course, up 8% so far, Manus.
Okay, lovely context. Thank you very much, Katie Greifeld. And finally, it's the stock of the day. NVIDIA falling for the fourth consecutive session. Earnings will cross the tape after the closing bell. Alex Webb is with me. Data centers and a great deal of expectation. Alex Webb, good morning. Set the agenda. What's going to be the most important number that we focus on?
As ever, it's going to be the outlook for the quarter that we're in right now. NVIDIA's fiscal year runs through to the end of January, so we're looking at what will happen through to the end of April. The market is looking for $21.9 billion worth of revenue. That's what the consensus is at the moment. It seems as though so far we've not really had any commentary from NVIDIA that suggests that the demand isn't there. The question is really about the supply. Can they get enough of these chips to satisfy the demand? Any indication that there'll be limitations on that is something that the market will clearly not take very well. The thing is with the valuation, of course, is that, yes, it has driven a lot of the growth across the market over the past year. It's added about $1 trillion in value over the past 12 months. This year alone, it's added 40. This calendar year alone, it's added 40%. It is trading at about 35 times its forward earnings. That is not actually massively more than a lot of its peers. In fact, AMD is trading at 45 times its forward earnings. But the expectations are high. It is guided for this quarter revenue of 20.2 billion. 20.4 billion, my apologies. That is, if it's any less than that, then that is clearly going to be a blow for investors.
Yep, well, it certainly sets lofty expectations. Alex, thank you very much. Alex Webb in London. Let's stick with the NVIDIA theme. Peter Cheer of Academy Securities discussed the impact of the chip makers' results this morning.
I think people are expecting a very, very good beat. And even if they beat, I just wonder who's turning around to buy. It could be one of those cases you get good numbers, it bounces right after the numbers, then everyone looks around, who's the buyer? Turns out no one's a buyer.
Are there any buyers in the market? Keith Lerner can answer that question for Truist. Keith, look, we're myopic in this, aren't we? By the way, I think I said earlier the market's set up for $200 million worth of swings in NVIDIA. That's $200 billion worth of swings in the options market. How important is this? I mean, we are so myopic. We are so short term. Is that going to define the next quarter's risk if NVIDIA can't get a hold of the supply that they need? Or do I need to be a more strategic investor and say, where do I want to be in chips?
Yeah, well, great to be with you, Manus. I think it's the latter. We have to kind of zoom out a little bit, because if you look at NVIDIA, at the end of the year, it was trading at 500, and now it's up, even with this pullback, closer to 700. It could pull back $100 and still be in an upward trend. And I think when you think about tech and the broader market more broadly, I mean, it's all about earnings, right? Tech has outperformed over this last year because the earnings momentum has been stronger. So I think what you want to see from NVIDIA is that continue. But I think more broadly, the way we're thinking about things, we were very positive off the October lows. Now we think we're more likely to trade in more of a consolidation, a choppy consolidation, as tech also cools off. I mean, let's not forget, tech was up 30% off the lows from October. And then semiconductors just this year were up over 20%. And we all know NVIDIA before this pullback was up 50. So I think a cooling is more likely. And as long as their earnings are fine, I think as you look at 6 to 12 months, I think that's fine. I think short term, more likely we'll continue to consolidate here.
And you talk about the outperformance in Mag 7. Obviously, Tesla, we can debate whether that drops out of Mag 7 or not. I think that's, an intellectual debate. But you talk about financials being the silent assassin almost in the background, up 26%. What was it? Mag 7 up 26.8%. But there was the silent assassin in financials, up 26.2%. Do you think it's time to delve a little bit deeper and perhaps to ditch those with commercial property exposure? HSBC tanking its commercial property exposure here in the United States this morning.
Yeah, and what you're referring to, Manus, is we did a study and we looked at since the October low, like what was the performance of these different sectors. And what was surprising was that financials were up almost the same as technology, and small caps were still outperforming large caps. So we become myopic just looking at the first 6 weeks of this year, and people kind of lose sight that we had such a big rally at the end of last year. To your point, more specifically on financials, when we talk about financials, we're talking about the broader sector, and it's much more diverse. In fact, most people may not realize Berkshire Hathaway is the largest holding in the financial sector, but you also have, credit cards, capital markets, insurers. Think about all the prices that are going up. That's one way to take advantage of that. And we do like some of the bigger banks in general. I think you have to, as you mentioned, have to be more selective as you go lowest market cap, and especially be aware of the commercial exposure.
But you got to hand it to Warren Buffett. I mean, who's the cleverest of them all on his call on Japan? I mean, he was just way, way, way ahead of the posse, wasn't he, this time last year, if you remember, into the brokerages. That's a whole other conversation. Where are you on the consumer? We just had Katie run through Toll Brothers. I mean, that's a very clear supply constraint story. But it does tell me something, again, perhaps about bifurcation, that awful overused word, in consumer markets. Toll Brothers, relative to what's going on at Walmart. We're getting choosier at Walmart, choicier decisions, versus Toll Brothers, which just extends and extends.
I think you're right. I mean, I've used the word bifurcation as well, so maybe I've overused it.
It's not personal, by the way. I've overused it and abused it myself, so it's not just you.
Yeah, but it is, when you think about the economy, it's, what economy, what consumer. The high-end consumer right now is doing pretty well, right? We have asset prices close to all-time highs. We have real estate prices going up. A lot of folks either don't have a mortgage or they're locked in at 3%. I will say even more broadly, though, I know there's the excess savings. We can debate what that actually is. But one positive, even with this uptick in inflation that we've seen, is that wage growth for really the first time during this post-pandemic period is now above inflation. So in our view, that should continue to support consumer spending at a steady pace. Now, we are expecting a step down from what we've seen the last couple of years, but in general, I think that's a positive. The other thing that's kind of a wild card out there, which could be a positive, there's these tax proposals out there as well, which could also benefit. We are in an election year, as you know.
We are, and we're also in a hot war year as well. I mean, I've had one or two people come on and say, listen, either way, either throughout this year and going into next year, regardless of who is in the White House, by the way, defense, cybersecurity, those deep expenditure areas that are unavoidable need to be re-examined and need to be upped in scale in the portfolio.
Yeah, I think it's notable that technology is the one sector that made a new all-time high, but the other sector that made an all-time high recently was industrials. And it's a very diverse sector, but to your point, defense spending is not going low, it's going higher. And it's not just in the U.S., it's global spending is likely to go higher as well. So I think that's a secular tailwind that's going to be here for many, many years. So again, I think that's a positive attribute. We're also seeing this manufacturing renaissance. You see it in the construction numbers just going V-shaped. And what's also probably missed somewhat is a lot of the different acronyms that we talked about fiscal stimulus the last few years, the IRA, the infrastructure bill. a lot of that spending is just starting to hit this year and to next year. So that will be a tailwind, in our view, for several more years.
Well, we saw that come through in Intel and Global Foundries yesterday, Keith, in terms of the potential lending to them. Keith, thank you very much for being with us. It is Keith Lerner there, my guest on the markets, coming up. A miss for HSBC despite record profits.
Our confidence is there in the reiteration of our 2024 target to deliver mid-teens returns. We've reiterated that target today.
We'll break down the numbers next on Bloomberg.
This is Bloomberg's The Open. I'm Abigail Doolittle. You're looking at a live shot of the principal room. Coming up, PIMCO Global Economic Advisor and former Fed Vice Chair Richard Clarida. That's at 3:30 p.m. Eastern, 8:30 p.m. in London. This is Bloomberg.
Our confidence is there in the reiteration of our 2024 target to deliver mid-teens returns. We've reiterated that target today. That gives you a measure of confidence, and it will give you a measure of our ability to continue to distribute to our shareholders. You know, if you look at all of what we distributed on 2023, that's around about $19 billion of capital return to our shareholders.
And another $2 billion buyback today. Noel Quinn speaking to the team a little bit earlier. That's after the company reported fourth quarter profit that fell 80% after taking unexpected charges on their holdings on a Chinese bank. This comes in as we've got rising interest rates boosting HSBC's full-year earnings to a record, with the bank's bonus pool hitting a decade high. Quinn's pay himself almost doubled. And that's, I suppose, at the same time, we saw Citi, the CEO there, Jane Fraser, also got a big pay bump for last year, up 6%. To $26 million. Tom Metcalf is with me. So Noel was in fighting form, which is jam for the shareholders, which is a buyback, and a reality check on China. But he does say, look, I wasn't forced to take these write-downs on China. It was not due to conversations with external parties. He's cutting commercial property. He's taking write-downs. He's kitchen sinking.
Yeah, I think that's a good analysis. I mean, it's pain today, and then the hope is they have a very clean sort of slate going forward. And they're very clear, or he was very clear on his messaging about China. They do not see this as sort of, a reason to be cautious. They, in fact, see a lot of growth there. Obviously, shareholders taking a different view. Shares down more than 5% still. Definitely a surprise. And maybe that's the biggest problem here, is it just wasn't expected. And, no one likes a surprise like this come very early on a Wednesday morning, right? It drops Asia time. And then you're suddenly like, oh, there's a $3 billion charge we weren't necessarily expecting. So perhaps no surprise the shares have fallen today. I'll sort of take the longer view and wonder if sort of, they'll rebound a bit tomorrow.
Now, since Noel's not with me, I can be cheeky and ask you the question. He's had a pay rise from the board, obviously. Does he deserve it?
Well, it's quite the pay rise, right? It's almost doubled. So, and I think that's maybe the disconnect you get when you have that big impairment like today. It just seems like a strange time to go through that. But I think what it really shows is, look, HSBC as a company, extremely sort of comfortable where they're at. They think underlying business is strong, and obviously they're rewarding their CEO for that. So that was a bit of an eyebrow raiser, just because you don't often see someone's pay double. But again, bit of context, I think it's risen to about $15 million or so. You compare that to a Jane Fraser, you compare that to a big Wall Street bank exec, and Noel Quinn is getting relatively underpaid somehow.
He'd probably be glad to hear that. Just a very, very quick chart for HSBC from September 2020 through to today. The stock is up 94%. I mean, not at the zenith that it was before, but it has had a nice updraft. Okay, Tom, thank you very much. Tom Metcalf. Next time I see Noel, I suppose he'll take a swipe. Let's talk about geopolitics. Politics here in the United States of America, of course, is expected to announce a fresh round of sanctions against Russia this Friday. Now, the proposed curbs are designed to hold Russia responsible for the death of the opposition leader, Alexei Navalny. Anne-Marie Jourdain joins me now to discuss this. Anne-Marie, again, I'm quite surprised about the huge flagging, early warning that this administration is giving for the upcoming sanctions. What do you think we can expect?
Well, they've been getting a lot of questions on when they were going to potentially move in terms of penalties because of Navalny's death. In 2021, President Biden was asked about a circumstance like this. What would happen if Navalny was to die? And he said there would be, quote, devastating consequences. The issue was in 2021, they had a lot more tools in the toolbox. They've used a lot of those potential sanctions and penalties they could put on Russia with Putin's invasion of Ukraine, which is why people think potentially it's going to be in the metal market. In December in the United Kingdom, they barred a number of individuals for trading some of these hard metals. And in the UK at the time said there's potentially more we can do when we work with international partners. So potentially this is going to be what the penalty is.
Okay, and Nikki Haley, absolutely defiant. I mean, this lady, despite what happens in South Carolina, she's sticking in there.
She says she's going to go. I think she hoped for a better showing. Well, let's see what Saturday brings. But, you know, she hopes for a showing in her home state. They twice elected her governor. The poll this morning that stuck out to me, Suffolk University, USA Today, 2-1. 63% Trump, 35% Nikki Haley. So it is a steep climb for her. And the director there saying the issue with the poll and the story of this poll is the depth of strength Trump has. But she remains, as you say, Manus, defiant. She's going to continue after the South Carolina primary.
Okay, and now he's got a new sneakers line to go as well. So there you go. All to play for in U.S. politics. Anne-Marie Hordern there on the political situation and the race in South Carolina. Sector price action. Abby is with me. Abby, what have you got?
Well, it's interesting. We have more sectors that are higher than lower, but we do have the S&P 500 heading to a third down day in a row. So this has everything to do with the fact that the worst sector on the day, tech, down 1.3%. That's a big, big weighting to the index. And of course, the SOX, the chip index, the chip stocks, I should say, a big piece of that downfall today on the day. Fears going into that NVIDIA quarter. We have communication services, another heavyweight sector, down 0.7%. On the other hand, you have a number of sectors that are actually up 1% or thereabouts. Energy, utilities, consumer discretionary. Let's take a look at one sector this week that's really slipped through the cracks to some degree. We actually talked about it on the Stock of the Hour yesterday. But the S&P 500 food and beverage and tobacco index, it's really outperforming so far, up 1.81%. This is, we have the 2024 CAGNY conference, and Kraft Heinz really talked about how they're going to invest in their technology. And not surprisingly, Manus, we did have talk about the weight loss drugs. Conagra saying yesterday that they, or this week, that they see positive trends against those weight loss drugs, that they are seeing volume increase in single-serve meals for those people trying to lose weight. So that stock is another reason why we have this index higher so far this week.
Abby, thank you very much. Great work through the morning. Coming up in the show, market moving events for your day. It'll come down to those Fed minutes and NVIDIA, but we'll just block it away for you in a moment. The stakes are high today. The definition of risk will be what will NVIDIA deliver. The Nasdaq is down by 0.8%. The market is positioned for $200 billion worth of variance. Puts and calls have traded. That is the scale of the volatility that NVIDIA could deliver today. As we discuss what the Fed minutes will be, we may get a little bit more acuity on what is it that's going to confirm for the Fed that they can begin to cut rates. And the risk is, of course, from Larry Summers flying the kite, that maybe even one of those potential outliers could be a rate hike. So we are nervous, and the oxygen is thin in Stockland. NVIDIA will define just exactly how rare that error will be. Here's your trading diary. I mentioned a couple of things for you. We'll get the Fed minutes at 2 p.m. Eastern Time. Mike McKee's hunkering down in Washington. We'll bring those to you live. NVIDIA reports after the closing bell. We'll take a look at the revenue growth along with the data centers, the trajectory, and the supply. The supply is critical for the growth story within NVIDIA. US PMIs and another round of jobless claims hit the tape on Thursday. That takes you to Friday with Fed Speak. Post these minutes, it's going to be the freshest intonation from Jefferson, Bowman, Harker, Cook, Kashkari, and Waller. So that's quite a digestion. Taking you through to Friday, you've got Warner Brothers and Discovery reporting their earnings. That's state of play on the market. You've had Tesla manage to turn it around from a pre-market tank. We're up at 198.06. We'll leave it with you. NVIDIA will define perhaps the next leg of risk on the NASDAQ, as it has put on nearly $500 million in market cap since the start of the year. That was Countdown to the Open. This is Bloomberg.